Welcome everyone to today's training. My name is Rachel Neighbors. You're here with Neighbors Group and Solo401k.com. And we have a very special guest today. Nate Bush from Bush Tax is going to discuss with us the Secure Act and how that affects your retirement plan. But before we get into that, you've been on these webinars with us before. On this side of the screen, you should see a chat bar. Let us know where you are joining us from. Let us know your name and what city you're joining the webinar from today. And also, we like to do a quick tech check. Let us know that you can see us and hear us. You can just type right into the chat on this side of the screen, yes, we can see you, or yes, we can hear you. That lets us know that our tech is working properly and that you are able to see and hear our presentation today. Awesome. Hey, Tom. Hi, David. Thank you. Good. You can see us and hear us. Awesome. Phoenix. Oh, great. We've got some Valley people here. All right. Austin, Texas. Beautiful. Ken, Tom. Hey. Hi. Thanks, everybody. Hey, Bill, Rob, Jeff. Okay. Wow. Maryland. Lipsy. Okay. Great. Awesome. So many people. It's really great to have you all here. And this is a really interesting topic of conversation. Well, it's interesting if you're kind of tax nerds like Nate and I. The Secure Act was a big piece of legislation. It changed a lot of things with retirement accounts. So that's what we're going to get into today. So first of all, a big warm welcome. Hi, Nate. Thank you so much for being with us today.
Great to be here. Finally get to be a part of these classes and everything that you do for your students. It's very exciting. Thank you.
Oh, thanks. And I know some of you that are on with us today, you already work with Nate as your CPA or your tax preparer. So for some of you, that's probably a familiar voice. It's nice to put a face to the name. And as we get started, so Nate, just give us a little bit of background on you. What got you interested, not only in accounting, but specifically helping small business owners? I know small business owners and entrepreneurs is the focus of Bush Tax. Why did you decide to help small business owners?
Well, my parents were small business owners growing up. We not only use small business, to pay the bills, but I mean, that's what life was. And, getting to see the passion that my parents put into it and getting to grow up in that and be the benefactor of all that hard work. It's always had a soft spot in my heart for folks that take the ultimate risk in life and put themselves out there. It is a heck of a risk, throwing away the time card that you use to punch 9 to 5 and just go all in on a business, especially with those that have families and children. There's a lot of lives on the line when you go out and take that risk, and finding ways to reward those that take those risks for me is just the ultimate thrill. Finding ways to strategize, finding ways to use the laws, take just a little bit of the edge off, because that's what every day is like in a small business. It's edgy, it's risky, it's high stress. And I know how much people value good help that can lessen that edge and, help them survive, especially in times like this. So, I'm not going to look back on 2020 and say, I'm thankful that the pandemic happened by any means, but we have thoroughly enjoyed being there for folks when they've needed us the most, especially times like this. So, again, I don't look at it as, doing anybody a favor. I'm just so fortunate to have the opportunity to help people like small business owners, in times like this. So in a nutshell, that's why I do it.
Right on. Thank you for sharing that. And I'm curious if you've seen this. I've certainly seen, because of the pandemic, more people are interested in small business ownership. We're seeing a rise in entrepreneurship and people striking out on their own, starting to look into things like the solo 401k, self-directed IRAs. I think that for many people, the pandemic showed us that some of the old system was broken. And, maybe the job security we thought we had wasn't really there. So some people are creating their own, what security they can, by having their own business or by taking their retirement planning into their own hands, investing in alternatives. I know you're a real estate investor as well. So that's also been an interesting trend to see, I think, too.
the light at any tunnel of starting a new business is independence, is freedom, is, being able to be your own person. And, when you look at times like 2020, I am not surprised at all that there's a huge surge in entrepreneurship, because again, being tied to a system that has let so many of us down, who wouldn't want to start their own business if they have the opportunity to do it? So I'm right there with you. Completely understand it.
Yeah, absolutely. Cool. Well, I know, Nate, that you have a short presentation that you've prepared for us. So whenever you're ready, go ahead and share your screen with us, and we'll get kind of right into the meat and potatoes of today's presentation. And guys, what we're going to do is dig into a couple of aspects of the Secure Act. I don't remember what the acronym stands for. I think it's like setting up every community retirement excellence, something like that.
We'll go with that.
The government, they always come up with these really long names just so that they can have like a cool acronym. So Secure Act.
Sure. So give me a second here.
Yeah. Awesome.
Let me know if you can see my slide there. We all good?
Looks good.
So yeah, there's been a lot of discussion of two significant acts that have been passed, in the past several years. Everybody knows about the CARES Act. I have been bombarded with questions about early 401k withdrawals, early IRA withdrawals, the 3-year payback of tax and this and that. That's all CARES Act stuff. That's an act that was passed in response to the coronavirus. The Secure Act, a lot of times gets overlooked. And there are so many good nuggets in this that can work well with those that have come across the IRA monies, like inherited IRAs. Those are looking to set up 401k plans for the first time. Those that are exiting, the 9-to-5 environment, they have employer monies they're looking to roll over. The Secure Act has changed quite a bit when it comes to this. And I think a lot of us are experts to some degree on the CARES Act. It's just as important that you guys familiarize yourself with the Secure Act and understand what opportunities exist here, especially if you're going out on your own, not only as a small business owner, but as a participant in your own self-employed retirement plan. So I've touched on a few items here. We're going to have a Q&A session. I'm sure some folks will have some generic questions, but I'm going to take the next couple of minutes just to highlight some of the most relevant parts of Secure Act and how they affect those that have opened up 401k plans. This is a little bit about my basic, company information. If anybody has follow-up questions, I know Rachel has her own protocol for those that are looking to learn more. I would ask if you guys could go through Rachel's protocol. But again, here's my contact information, for anything else or any other questions you may have as well. Go to the next slide here. One of the most basic new changes via the Secure Act is the solo 401k plan establishment. Prior to the Secure Act, the solo 401k plan must be established by the end of the year, 12/31. So if we're thinking about 2020, today's January 20th, 2021, under the old rules, if you had not established a plan yet, you're done. You cannot participate in a 401k plan. There are other plans that you can establish into the next year and still have them apply retroactively. Old rule stated solo K, done. You had to have it done by the end of the year. After the Secure Act or with the Secure Act, now you can establish a solo 401k plan by the business tax return due date plus extensions. I'm going to go over that just a little bit. If you have an S corporation, your S corporation tax return is due March 15th. You have until March 15th to establish a solo 401k plan and fund it and have it work for 2020. That is all with the Secure Act. If you choose to extend that return, you actually have until September 15th. That is for S corporations. If you own a partnership, you have until March 15th and September 15th as well. If you have a Schedule C or a sole proprietorship, just your normal run-of-the-mill LLC business, you have until April 15th. That is the initial deadline for a 1040 for a sole proprietorship included, or October 15th with extension. So the Secure Act has given you this ultimate flexibility. This is a great positive with the plan. I would still caution folks, especially those with S corporations, as you know, 401ks are married with payroll. All right. So don't confuse funding these 401ks later in the year for the prior year with running payroll. Payroll still must be run by certain more stringent deadlines. Consult your tax professional so they can ensure that you are adhering to the payroll deadlines, even if you're trying to stretch out this 401k funding for the prior year. It's a little song and dance you still need to go through. A long story short, the plan establishment, you still have time if you wanted to kick in for the prior year. A lot of you may have SEP IRAs. The rules for the SEP IRAs, it basically marries the 401k to the SEP rules. Prior to the Secure Act, you would have until September 15th to fund a SEP IRA, no problem whatsoever. The 401k rules now mirror and marry the SEP IRA rules. Pretty easy, pretty simple. Big plus, big easy to understand benefit that comes with the Secure Act. That's the first point I'm going to touch on. The next big change, RMDs, required minimum distributions. For any novices here, required minimum distributions basically say, hey, you've got a lot of IRA money that's been building up over the years that's tax deferred. At some point, the IRS is going to want to tax that money. So they have said prior to the Secure Act, once you turn 70 and a half, you've got to start liquidating it basically like an annuity. So you reach 70 and a half, IRS tends to think, you got about 20 to 25 years left in the tank. They start having you annuitize your IRA or 401k at that point over the next 15, 20, 25 years, depending on certain schedules. That's the purpose of the RMD, is get you to annuitize and liquidate your IRA so they can tax that again. Roth IRAs are exempt from the RMD rules while you're alive. That money is eternally tax-free. The IRS obviously doesn't have a huge vested interest in getting you to liquidate that. They're not going to assess tax on it anyway. So, from their standpoint, they really don't care. And when you pass, there's different rules for that. And we're going to get into inherited IRAs and what happens if somebody inherits your Roth. Those rules are a little different, but as it pertains to RMDs, that's only a pre-tax issue. So that does not apply to Roths. After the Secure Act, now the RMD time clock starts at age 72, up from 70 and a half. So it just gives you a little bit more flexibility to delay your RMDs. And now that clock starts at 72 versus 70 and a half. Small little change, but hey, it's a nice little benefit. It gives you another year and a half of that pre-tax money to grow tax deferred until you have to start liquidating it. Roth's still exempt. Nothing's really changed there before or after the Secure Act, right? Again, another little basic tweak due to the Secure Act. The real complicated stuff kind of comes up next with inherited IRAs. Inherited and stretch IRAs. One of the neatest parts of the tax code existed prior to the Secure Act. Inherited IRAs. Let's say you've got a parent, you've got a grandparent, they've built up a fortune in an IRA, and something unfortunate happens, or nature happens. You inherit their IRA and all the pre-tax money that came with it. Under the old rules, you could take that IRA money and you could stretch it over your remaining life expectancy. You're 20 and you inherit grandpa's IRA and there's $1 million in it. Guess what? You can annuitize that IRA over your life expectancy. The term for that was a stretch IRA. Your normal RMD rules require you to annuitize from age 70 and a half on. Like I said, 15, 20, 25 years. It's a very short schedule, which means big distributions. Under the stretch IRA rules, you would have a long schedule, especially if you inherit at a young age, thus the moniker stretch. The stretch is the annuity out, short distributions, a great estate planning tool. This is a big negative with the Secure Act. We're done with stretch IRAs, at least as they pertain to traditional IRAs. They don't exist anymore, right? Total distributions out of inherited IRAs must happen within 10 years after the date of death, all right? So you inherit grandpa's IRA, you inherit that $1 million, and you're 20 years old. By the age of 30, that thing's got to be liquidated. You got to pay your tax. Just is what it is, huge negative. But there is a big exemption buried into this. If you are a spouse, if you inherit your spouse's IRA, the old stretch rules still apply. You can annuitize over your own life expectancy. No big deal. So that's a planning point. When you're setting these up, these 401ks, when you're setting up your IRAs, think of your beneficiaries. Spouses are usually your default beneficiary. It's just this huge benefit if you've got a wife or husband stepping in your shoes. There's also other exemptions, minors, certain children. They can also use those rules in their benefit, but the spouse tends to be the most relevant one. Again, if you want help or assistance or planning, structuring your beneficiaries, again, consult your tax professional, consult Rachel, Jeff. They'll do a great job of making sure that all these things are being taken into account. Just stresses the importance of having some strong team members here. But again, this is all estate planning. And I know a lot of you folks are real geeked and excited about setting up the 401ks and what you're going to do while you're still around. You have got to think about what's going to happen when you're not around too. That's what planning is. It's a beginning to end, beginning to end type process now, and in the future. Just something to think about. So again, you're a spouse. You basically have stretch rules as it pertains to IRAs. Also, another change to the Secure Act: there is no age limit on traditional IRA contributions anymore. All right. This is huge. This is absolutely huge, and I want you to listen why. Before the Secure Act, you could no longer contribute to a traditional IRA once you reach age 70 and a half. All right. On paper, that may not seem like a huge deal. But the reason why I think it's a huge deal, it's because of the backdoor Roth IRA. And I'll take a couple minutes to explain that. Basically, if your income is over a certain amount, it's about 190 for married couples, you are not allowed to contribute directly to a Roth IRA. I'm talking about the normal $6,500 a year contributions. This isn't the mega Roth stuff or the after-tax 401k. This is just normal IRA contributions for about $6,500 to $7,000. Those cannot be made directly if you make 190. So the workaround to that, it's this really dumb loophole, but it exists. You can make a non-deductible traditional IRA contribution on day one, and on day two, assuming other criteria are met, see your accountant, et cetera, you can convert that non-deductible traditional IRA contribution into your Roth. It's just a backdoor contribution. Again, it's really dumb that the rule exists, but it's beneficial, works to your credit. The reason why this is all significant is before, under the old rules, since you can't put money into a traditional IRA once you reach 70 and a half, you can't do the backdoor because the traditional step one, converting to a Roth is step two. Now that you can put money into a traditional IRA once you reach 70 and a half, you can now do the backdoor Roth IRA when you reach 70 and a half or later. Really nice. Just a reminder with Roths, they do not have RMD rules once you put money in, but they still do have 10-year rules. All right. Inherited Roth IRAs still have 10-year rules. The benefit to that is, even though you have to comply with the 10-year rule, all that money is internally tax-free anyways. So even though you have to liquidate within 10 years, it's all tax-free. So, again, it's nothing, nothing huge from a tax consequence standpoint. So again, a lot of folks tend to miss out on this backdoor Roth IRA, strategy here. If you're getting into retirement savings or this or that, I think a Roth needs to be a huge part about what you're doing. It is one of the only vehicles out there where you can put money in, you can grow it aggressively, and it's eternally tax-free. That doesn't exist in a lot of other places. Backdoor Roth IRA helps feed into that strategy.
This seems like this could also be part of the planning structure that you were talking about earlier too, Nate, right? I mean, there are people now who, even if they're over age 70 and a half, they might still have some income generation from real estate or something like that. Maybe they're still working a little odd job doing some consulting. So if they can put money into these IRAs where they previously couldn't, then they're able to continue to grow their retirement assets for their beneficiaries, especially if they're doing this backdoor Roth. Do I have that right?
Absolutely, you do. Absolutely, you do. Yes, you have that perfectly right. So that's pretty much it in a nutshell for the Secure Act tax updates. I think that's the most relevant pieces that pertain to to the Neighbors Group students here. When you're starting off a 401k, lots of good information in the Secure Act. There's a lot of other little pieces we can pick apart and go over. They tend to be they tend to be so small, they only apply to smaller crowds. But what I've picked out here tends to be the most all-inclusive, most relevant items to a broad audience. So again, it's important if you have any questions about the Secure Act, you consult with an accountant that fully understands the law, and even more importantly, an accountant that understands solo 401ks. It's just a different world. It's such a different world. The minute you leave 9 to 5, you start to go out on your own. It's, saving up for retirement can be done more aggressively, more strategically. And for the same reasons you started your own business, it can be done independent. It can be done non-conventionally in a way where you can make more, save more, and have greater control. All reasons why we start small businesses in the first place.
Absolutely. Gosh, thank you so much for that, Nate. I really appreciate it. You'll see, guys, down here at the bottom of the screen, there's a little button that says Contact Nate. If you fill out this form, this is going to send a message directly to Nate's team, and it's also going to let him know what you're looking for. Are you looking for some consultations? Are you needing full-blown tax prep? Because Nate's team does do that. They do full-blown tax and accounting. So wherever you are on that spectrum in your business, it'll also give them a time frame if you need someone to contact you right away, or if this is part of your team that you're building. So make sure you click on that little button there and submit the form to Nate. Now, we do have a few questions that have been submitted here. As we go into these questions, I want to make a disclaimer on sort of behalf of everyone. Nate is not magically becoming your tax accountant just because you are on this webinar. So what Nate will do is answer these questions to the best of his ability for a general audience. If you have questions about your specific situation, then what you want to do is click on that link and submit a form to Nate's team. As you all know, running your own small business, your own solo 401k is highly individualized. There's a lot of variables. What type of business structure you have, how much money you're making, your deductions, are you doing Roth, pre-tax? It's very specific to you. So if you have questions specific to your particular situation, then we recommend that you complete that form below, click on that button at the bottom of the page, and reach out to Nate's team. So with that said, we'll get into some general questions. And also, guys, I know that there have been people that have just sort of, they see the word CPA, their eyes light up, and then they want to kind of start asking all kinds of questions. We really want to try to keep these questions as closely tied to the Secure Act as possible, because that is the purpose of today's meeting. So if you ask questions about other filings that are not relevant to the Secure Act, then what we would recommend is that you consult your tax professional, or if you do not have a tax professional yet, click that link right below and set up a consultation with Nate's team so that they can get into specific questions for your situation. We are going to try to really keep it focused today on the Secure Act. Otherwise, I know people get stars in their eyes and they go, CPA, ask all the questions. So we're trying to stick today with Secure Act. All right. So our first question comes from Marchalee. She says, I made my employee contribution for last year. I think she says employee twice, but I think I know what you're trying to say, Marchalee. I made my employee contribution for last year. For the employer contribution, I did not. Or it might be employee, I'm not sure. Can I still make that contribution without having made an election by 12/31? And Nate, I know you can answer this generally. We don't know, Marchalee, your business structure here. You put the word employee twice, so we're not sure which one you did. Was it employee or employer? But Nate, if you can generally speak to this.
Sure. So the technical rule states that you need to make an in-house election or an in-house declaration of what the employer portion will be. So, it's important in your desk or in your file, you leave yourself a little bit of a note for your records only as to what that will be. Technically, that's supposed to be in place by 12/31, but the actual monetary contribution itself, that needs to be contributed into the plan no later than September 15th if you're an S corporation, April 15th if you're a partnership or a sole proprietor. If you extend those tax returns, then you have until the extended deadlines, which would be September 15th for S corporations and partnerships, October 15th for individuals, sole proprietors, 1040s.
Great. Thank you, Nate. Awesome. Okay. Our next question comes from Dirk. Dirk says, I heard that RMDs apply to 401k accounts, whether Roth or pre-tax. if this is correct, and you are correct, Dirk, even Roth 401ks have RMDs. Roth IRAs do not, but Roth 401ks do have RMDs. So if this is correct, it is. Rolling the 401k Roth to a Roth IRA would negate the RMD, right? I guess let's do that question first. Is that correct? Right. Good.
Short answer. Right.
Yeah. And, Dirk, this is a strategy that some of our clients employ with the help and guidance of their tax professional. You might be building up assets in your Roth solo 401k because your contribution limits are quite aggressive there, which is awesome. Sue, RMD stands for required minimum distribution. When you turn age 72, the IRS wants their money. They want your taxes, so they require you start taking money out at that age. The Roth 401k does have required minimum distributions. What some of our clients do with the help and guidance of their tax professional is they'll begin to roll the assets from the Roth 401k to a Roth IRA before age 72 to avoid the RMDs. Okay, and the next part of the question here from Dirk is, how are non-traditional assets, crypto, real estate, et cetera, in a Roth 401k rolled to a Roth IRA?
So this is a question we get quite often. So here's the benefit of having these things in tax deferred or protected accounts like these. It's your job as the overseer of your own fund, especially when you're self-directing, to value things when they're rolled over, and that value needs to be shown on a 1099. And I've had situations where folks have rolled non-cash assets over, and it creates a lot of complications because now you have taken on the responsibility of valuing that asset. Oftentimes, what folks do is they'll have to liquidate the asset into some sort of a cash amount, roll it over, and in the case of cryptocurrency, they can repurchase it at that same amount. That's usually the big solution to that. Obviously, if you're holding on to real estate or notes, that can get a lot trickier. It causes a lot of issues. If you have real estate or notes, I'm going to punt on that. I'm going to say you're going to have to check with your tax professional because there's a lot of ins and outs with that. But the easy answer is, liquidate to cash, roll over the cash amount, which is extremely easy to value, and then repurchase those things in the new destination. And you don't need to worry about owing tax on any of that. These are rollovers. So there's no tax effect for doing this. But there is a functional issue if you're dealing with certain assets where repurchasing might cause some complications. Again, if you're getting into assets that are difficult to repurchase, it's best to coordinate with a CPA for your own particular situation.
Definitely. And I know specifically when it comes to real estate, there's different ways people value those assets. Sometimes they just do a tax appraiser. Sometimes they do a broker price opinion. And those values can vary wildly. What I know some attorneys sometimes recommend, again, this is not tax or legal advice, you guys need to check with your individual tax professional here, is to do a full-blown appraisal. It's expensive, but that might get as close to a true valuation rather than something like just the tax assessor, which is usually a lower value. The IRS doesn't get as much money in their taxes, et cetera. But again, this is a great question, Dirk, for you to chat with your tax professional about. And if you have questions about these specific situations for your individual case, then fill out that form below so that someone on Nate's team can reach out to you. Okay. Let's see here. Next question. This is about I'm trying to look for the Secure Act questions. I know you guys got real excited with CPAs being on here. Okay. Next question comes from Ken. Retirement plan startup costs credits are a part of the Secure Act. Does this apply to a solo 401k? Usually no, is what I've heard. Nate, what do you think about that?
I still agree now.
Yeah.
The incentive of setting these up is meant to apply for third-party employees. That was the original intent of the credit, and that is still the intent of the credit.
Yeah, agreed. Okay, so next question is anonymous. It says, seems like the IRS hasn't updated with the information that we can set up the account until the tax filing date, right? It still says you need to set up the account by 12/31. Can you please clarify? I'm not sure where you're looking, Anonymous. The IRS does have the information regarding the Secure Act on their website. In their defense, the Secure Act was passed in December of 2019, and we went into a pandemic 3 months later, and then they had to release the CARES Act. I think they're pretty behind on everything.
That's a really gentle way of putting that.
Yeah.
We had to place a call on behalf of a client the other day that was checking in on a refund for an amended return that was put into effect, I think back in July of 2020. And I think somebody slipped at the IRS and notified us that they're behind on 7 million tax returns right now that they're trying to process. And these are paper returns. That's in addition to the electronic ones they're processing. So they are way behind. They're incredibly behind. It's causing a lot of issues. Before all of this, the IRS was painful to work with, but they at least were able to keep up with some sort of a steady pace. Right now it's a disaster. Oh, and we just changed administrations today, so we have that too.
Right. Yeah. So if you're solo 401k clients of ours, you know that we get your tax ID numbers online through the IRS SS4 system. It's their online application. We do that immediately. Well, the first 10 days of the year, because Adobe Flash Player is no longer supported, the IRS entire online EIN system didn't work. So in the past, what we've done is reverted to just faxing in applications like it's 1996. They told us there's a 45 to 60 day wait just to issue those tax ID numbers. So they're overworked. They're totally stressed. As plan providers, we're still waiting on guidance on the CARES Act. We have to try to be patient with the IRS as best as possible. They're trying to deal with a lot. So, but Anonymous, to answer your question, the Secure Act, which was passed in December 2019, was very clear that you do have until your business tax return to set up your solo 401k plan and make contributions for that year. Again, within the caveat of understanding, did you run payroll, things like that, that your tax professional will be able to assist with.
Rachel, I noticed one question over here on the side that I wanted to
go
answer.
for it.
It's a general question. Somebody had mentioned that they're in California, they're moving to Louisiana. I can get the feeling they have a lot of different things all over the place, and they were asking if I can help folks that are outside of Ohio. That's where I'm stationed, is Ohio. My CPA license is uniform in all 50 states. We presently have clients in 45 of the 50 different states. So yes, you can do anything you want, wherever you want. I can help you. That's not any sort of issue whatsoever. We've been doing it for 15 years. Folks are asking us if we know how to use Zoom and Google Meets and this and that. My response was, I was Zoom before Zoom was Zoom. I've been emailing, I've been texting. I have clients that I've been working with that I've never met face to face. We're email buddies. So, working virtually for anybody is not any issue for us whatsoever.
Awesome. Cool. Yes. Thank you. Wonderful. Glad that we covered that. So anywhere that you are in the country, Nate is able to assist. I know, Glenn, you chimed in as well. You're in Texas and Nate's been helping you out as well. So yeah, anywhere that you are, the Bush Tax team is able to assist you. Okay, next question. I'm trying to keep these to the Secure Act, guys. I know you have other questions. We will be picking back up on our solo 401k Q&As to help you. Yunhee, your question was, how do you submit all of the papers? The first thing to do, as far as in having Nate's team help you, the first thing to do is submit that, click the link at the bottom of this page and submit an inquiry so that Nate's team can reach out to you. They will guide you through exactly how to send any documentation that they need. Nate, is that cool to say?
That's a great start. If you're a paper person, if you're an Excel person, if you're a QuickBooks person, we work with all sorts of different types of people. And we've thought through that. We have refined this process for 15 years. Like Rachel said, the best way to get started is that little link right there. You click that, you get started, and we can help you from there. So not an issue whatsoever. That's the best way to get started.
Awesome. And then for Jyotsna, he says, what kind of fees do you charge? Well, we're not going to do a in-depth analysis on fees right now, and this varies per scenario. But Nate, would you just recommend that for an individual analysis for someone to complete that form for you? Because things are so highly
Yes.
specialized?
So I'll put it this way, Rachel. You mentioned my real estate background.
Yeah.
If I have a tenant call me about a big plumbing leak, there's water going everywhere, it's a disaster, and I call a plumber up and I ask him to come out, and he's able to give me the quote over the phone without actually coming out and seeing what's going on, that's a red flag to me. I want a plumber that's going to come out and assess the situation and, not only tell me what's wrong or what's right, but also give me a quote after he's sized up the entire work. I just can't help but think like that because that's what I expect from the people that work for me. I would encourage you to think that same way. We're willing to put in, time looking into your situation and seeing what's going on and giving you not only a good quote, but a scope of work. Because sometimes folks need things or there's value we can add that you may not be aware of. And that kind of comes back to that plumbing situation. I've had contractors come out and they've pointed out things that are wrong that, I had no idea. So, there's value in having somebody that's willing to put the time into understanding you before telling you, what the scope are or what the scope is and what the fees are. But in general, I'll put it to you this way. Our fees are middle of the road. We're not a price leader when you look at us from the grand scheme of things. But when it comes to finding a small business minded CPA that runs a business himself, he has his own solo 401ks and self-directed accounts. He manages his own real estate. Finding a CPA that not only understands how all those things are taxed, but also understands all of those things in practice, we're a bargain.
Agreed, 100%. And I mean, I want to come back to the solo 401k piece because for many of you who are on here who are clients of ours, sometimes you come to us because the current tax advisor you're working with has never heard of a solo 401k. They tell you it's illegal, that you're not allowed to invest your retirement funds into alternative assets, which is not right. So we want to make sure that we have resources like Nate that are available to you we've known Nate for a long time, but before we put, a CPA on our resources list, we chat with them. We want to know what their background is and are they familiar with the solo 401k and small business owners. So please remember that specialized knowledge is really important because that can make or break the difference between a lot of your tax, big or small tax bills. So, okay. All right, we've got some more questions here about the Secure Act. We're going to get into those. So Michael says, does the Secure Act allow a business owner to start a solo 401k in 2021 and fund it from 2020 based on the new laws? Yes.
Yep.
Yes, that's exactly what it does, Michael. Yeah, that's exactly what it does.
Absolutely. It's some of the best news that we have yet from the Secure Act. Absolutely, yes. Resounding yes.
Yeah.
Now, there are deadlines, Michael.
Exactly.
You do have until the tax return that the business is reported on to set up the plan and fund it. Again, if you are a sole proprietor that has no sort of corporate election to it, you have until April 15th. If you're running this through a partnership, you have to fund this by April 15th. If it's through an S corporation, you have until March 15th. And if you extend any of those returns, you have an additional 6 months past those deadlines to set up the plan and fund.
Awesome. Thank you. Thank you, Nate. And thank you, Michael. It's a great question. Okay, we've got a question here about sole proprietorship filing. So we just talked about this. For sole proprietors, I know that we file our independent contractor income along with our personal filings. So I'm not sure how the solo 401k would fit into an annual filing. So one quick note here. Remember, guys, the solo 401k does not have a tax return. So it's a tax-deferred retirement plan. When you file your personal taxes and your business taxes, there is, in 99.9999% of cases, there is no additional tax return for a solo 401k plan. So Yunhee, if you are a sole proprietor, and we do recommend that you reach out to Nate because I know, Yunhee, you have some specific questions. When you file your independent contractor income and your personal filings, that talk with your tax professional, but that should probably cover most of it because a solo 401k does not have its own tax return. Nate, am I on base here?
Yeah, there is one line on your 1040. There's one line on the first couple of pages that you disclose to the IRS what your deduction is for funding a solo K. and that line includes both the employer and the employee portion. That's just disclosed there like any other deduction, like a mortgage interest deduction for your home. So the sole proprietor is a very simple component of a tax return you are already required to file. That's the 1040. And yeah, as Rachel mentioned, most of the time a solo 401k does not have a tax return per se. Once you get over a certain amount, I think the limit is 250,000. Once the 401k has a value of $250,000 or more, there's an annual disclosure. I think it's a 5,500 you have to file. But in a lot of cases, especially with startups like this, you're not quite there yet.
Awesome. And we've had a couple of questions here about crypto and Bitcoin. Nate, does your team deal at all with any crypto filings, like if someone has to pay capital gains on selling crypto holdings?
Yeah. The rules are very, very similar to just normal stocks and securities. I know it's not, it's a debased currency of some sort or this or that. And it's not quite where, normal stock exchange, stocks and bonds are. But the tax rules were put into effect to mirror that. We've done tax returns for those that mine cryptocurrency. We've done tax returns for those that trade it, those that just sit on it, those that exchange it for other forms of crypto. We've dealt with all of that. That's not a concern for us or my team whatsoever.
Awesome. And Doreen, I know you also had a question about Bitcoin and real estate. So there is your answer there. Okay, so Jyotsna says, after contributing to a traditional 401k via the solo 401k last year, do I have the option to convert to Roth now? Yes, you can convert to a Roth anytime you want. If you convert now, it's going to count for 2021 because when you move the money is the tax year that it counts in. And Nate, please tell me if I'm wrong on any of this stuff, but if you move the money now, it's a 2021 conversion.
There is a 12-month rule that you need to keep in mind. You can only convert once every 12 months. We've had a lot of clients goof up on that. Again, I would not recommend anybody get into habitual converting on your own. You absolutely need a CPA that's looking over your shoulder, making sure that you are converting at appropriate times. Very powerful tool. And like most powerful tools, they'll bite back if it's not used the right way.
And also, guys, keep in mind that 401ks and IRAs have different rules as far as rollovers, conversions. Sometimes if you're rolling over money from an IRA into a solo 401k, they'll tell you can only do that once a year. That's usually referring to an indirect rollover. So there are intricacies, there are nuances when it comes to the rules for conversions, for contributions for an IRA and a solo 401k. Another reason why you want to make sure you have a tax professional like Nate who understands the intricacies of the solo 401k. All right, so let's see. We have, more Secure Act questions. Let's see. And we are coming to the end of our time here, but let's see if we can get through a few more of these questions. So Aditya says, is it correct to assume that the Secure Act allows the extension of dates for both opening the solo 401k and using a backdoor Roth conversion?
So with the backdoor Roth conversion, well, let me break this down a little bit. On the opening, yes, it's similar to Michael's question. Those deadlines until the filing of the returns and the extension of those returns, that applies to not only funding it, but also opening it. So again, extremely flexible deadlines for doing that. As far as the Roth conversion, or I'm sorry, the backdoor Roth IRA, presently right now, you only have until April 15th to make the non-deductible IRA contribution. And as far as the conversion goes, there's no real deadline, so to speak. It's a two-step process. Step one, make your non-deductible traditional IRA contribution, which can be made until April 15th. That is tied to your individual tax return. And unlike these other things, there is no extended deadline on that. All right. It's still April 15th for traditional IRA contributions. All right. And as far as converting to a Roth, it is in your best interest to convert that non-deductible contribution to a Roth as soon as you possibly can. The reason for that is any earnings that grow on your non-deductible contribution are taxable. Well, you want that window between the non-deductible contribution and the Roth to be as small as possible. So any earnings you make on that money, it's done under the Roth and not the non-deductible IRA. So in terms of deadlines, is there a deadline? Well, that depends on what your goal is. If your goal is to not owe any money whatsoever and let your money grow eternally tax-free on your money, then your deadline is immediately. You have got to convert immediately, keeping in mind that 12-month rule. You only get to do a conversion once each 12 months.
Great question and great answer. Thank you. All right. Let's see. Natalia, is a backdoor Roth only for people that are age 72 or older?
No.
No.
No, everybody. It's for everybody. It is for everybody. And speaking to a bigger point on Roths themselves, I'll throw something out there. In my family, I have 6 children, and between my wife, myself, and my oldest 3 kids, we all have Roth IRAs, all of us. And this should be raising your eyebrows right now. The reason why we all have Roth IRAs, one, for the obvious, for my wife and I, we want to have an eternally tax-free source of income. But for the kids too, a lot of you small business owners, I'd really consider finding a way to employ or start paying some of your own children and having them contribute to their own Roth IRA. I'm not going to go down that rabbit hole too much because there's a lot of nuances that go with that. But I want a lot of your heads turning and really thinking about the power of Roths. Who does a Roth make sense for? We said anybody can open them up. Well, a Roth makes sense for somebody that has relatively low income, right? Because the pre-tax accounts are beneficial. If you have a lot of income, you can get a really, really great tax deduction in a really, really high bracket. Well, what about those with really low bracket? Do you need that pre-tax deduction? No. So maybe a Roth makes a little bit more sense. And it also makes sense for people that have a lot of time on their hands for that money to grow eternally tax-free. That sounds like my kids. Folks, my kids are putting in some good, honest work. I'm paying them a reasonable pay, and they don't need the deduction. If I pay them, 3, 4, 5 grand a year, and they're already getting, other standard deductions here and there that wipe out that income anyways, I can contribute that money into a Roth. And if my 12-year-old is busting his rear for a summer, learning the value of hard work, and I pay him and I get a tax deduction for paying him, by the way, and then he turns and he puts that into a Roth at 11 or 12 years old, guess what? He's got about 60 years until retirement for that money to grow eternally tax-free. So we've all seen these charts of compounding rates of return and this and that, and we all see that your money can double or triple in 10, 15, 20 years. Imagine what it does in 60. Just because mom and dad paid you, put money into a Roth, and let that just grow. A lot of kids even forget about it.
Yeah.
You don't even know that money's there growing for them. So I know I went way beyond that question, but the big message is Roths are for everybody if done the right way.
Yeah, it's a great gift, I think, to give to your kids to start their retirement planning early.
Best possible gift you can give them.
Yeah, and remember, guys, we're talking about Roth IRAs in this particular instance. I know some of you are going, kids can qualify for solo 401ks? Yes, maybe, but in this particular question, we're talking about Roth IRA.
Yes,
this is a Roth IRA. Okay, next question from Mita. What if somebody receives a 1099 and does not have a corporation? Can they still do a solo 401k? Yes, you can. All right, next question from Kent. Now, Kent, in looking at this question, I'm already going to tell you, you probably need to do a consult with a tax professional or with Nate's team, but we'll ask the question generally. Do I need to amend my 941 or 940 and W-2 if I make my contribution in March? I'm guessing you mean employee. Can I just change box 12 on W-2 now?
Well, if you're having to go back and redo this, this is very general advice. But the general mechanics would be, yes, you're going to have to go back and amend some returns. If you haven't filed the W-2 yet, then you can still modify the box to show the reduction in the taxable wages for the contribution. The 941s, you have until January 31st, 2021 to file those along with the W-2. If you're using an ADP or Paychex or this or that, which I would not recommend for solo 401k stuff, but if you are, you would still have to go back and amend any fourth quarter forms for any deferrals, whether they be employee elective contributions that have been made up to the deadline. Yeah, you're gonna have to go back and amend some forms if those have already been filed and don't reflect that. Consultant and accountant, everybody's situation is different. Very, very confusing.
Great question. Okay, so I'm going to just try to blast through a couple more questions here. So Marilyn says, can I have Roth and non-Roth money in the same solo 401k? Yes, but you need different accounting methods. So typically our clients will have a pre-tax bank account or a pre-tax brokerage account and a Roth bank account or a Roth brokerage account. If you're doing mega backdoor, then you also need an after tax. This is akin to a non-deductible. You need to account for each tax classification separately. So your solo 401k is a trust. It includes sub accounts for pre-tax, after tax, and Roth, but you are the plan administrator, or hopefully you have a CPA or bookkeeper helping you. You need to account for each tax classification distinctly, separately. You know how much money is in your pre-tax. You know how much money is in your Roth. You know how much is growing in each. You know how much you've contributed or rolled over into each. Nate, am I on base there?
You are more than on base. I mean, that's absolutely required and mandatory. There's got to be separate accounting. When you talk about pre-tax and post-tax buckets, you almost have two different sets of tax rules for these types of monies. If you mix this up, if you combine it, you have an enormous mess on your hands. You have got to be so diligent keeping track of separate accounts. Absolutely.
Agreed. Okay, we'll try to get to one or two more. Aditya says, on the post-tax contribution to a Roth IRA. So I think, Aditya, what you mean here is a non-deductible contribution that you're converting to a Roth IRA. They say, can we contribute for both 2020 and 2021 before 15th of March, and then convert all of the amount via a backdoor Roth in one shot?
Yes, absolutely. You can absolutely do that. Yes. You could put in $6,000 for 2020 on March 14th, and then you can put $6,000 for 2021 on March 15th, and then on March 16th, do a $12,000 conversion. No problem whatsoever. Very, very good question.
Awesome. Okay. All right, we'll do two more, and then we're going to call it for today. And I know you guys have so many questions that you've answered or that you've submitted. Thank you, Nate, for answering so many of these.
Hey, it's no problem.
And guys, we will continue to have these trainings. I know it's so helpful for you to have access to a CPA, especially one that is as knowledgeable about small business ownership and solo 401ks as Nate. If you have a lot of burning questions and you're feeling a little bit like frantic, like you need to get these questions answered, what that should tell you is you need to reach out to a tax professional. It means that you need support and you need guidance, and that's okay. Having your solo 401k means you are building your team of experts to help you. Neighbors Group is here to be your document people. We're your paperwork people. We'll facilitate these questions for you, but your tax professional is the one that's going to really get into the trenches with you. So if some of this stuff is going right over your head or you're feeling a little overwhelmed, then what that should tell you is, hey, I need to reach out to Nate's team and get the financial house in order, because that's what they're here for. They know the answers to these questions. They will be able to guide you. All right, so there's that link right there. We'll do two more questions. Let me see if I'll pull out some for the Secure Act. All right. We'll do one quick one here from Mita. I can probably help with this one. Mita says, I have multiple businesses, one with W-2 employees and the other without employees. Both businesses are totally different from each other. Can I still open the solo 401k in business without employees? The answer is maybe. It depends on how much you own of the business that has employees. Without getting too nerdy, the IRS has something called a controlled group. Mita, if you own 80% or more of a business that has full-time W-2 employees, the IRS is going to look at all those businesses as one big business, and they look at that for qualification purposes. So Mita, if you own 80% or more of a business that has W-2 employees, and then you have this sole proprietorship you own 100% of, that kills your qualification for all of your businesses, because the IRS does not want you to be able to just whip up a new little business and not have to help your other employees. So I would say in this case, you would want to talk to your tax professional, and they'll probably help you do a little diagram looking at ownership of all of your businesses to see if you are a controlled group or not. Nate, am I pretty right on there?
You are absolutely right, but understand the rules change a bit. When you have a spouse, a spouse
True.
can have a business that they
True.
own. That doesn't mean that spouse's business falls under the controlled group.
True.
So that controlled group is determined on a per person basis. In other words, your spouse could set up a business with a solo K, and if you have your own business with employees, they're not taken into consideration with those rules. They're totally independent. But again, like Rachel mentioned, I'll get out my green accountant hat calculator and we'll draw up the
Is it
diagrams.
one of those visors? Is it with the visor?
Yeah, it's one where you can barely see through it. I got the little lamp next to me too. I got
maybe an abacus. Do you have?
That's right.
Moving beads along. Fabulous. Okay, awesome. Yeah. So guys, as you can see, the not only just the solo 401k, but all retirement plans, they have a lot of, you have to have this brain that does what we call if then statements. If this, then that. If this, then that. There's a lot of those decisions that have to be answered or questions that need to be answered before you can figure out which direction you're going in retirement plans. And that's a lot for you to have to keep in your own brain. That's why we have brains like Nate to help out. Okay, so we got one more question here, and then we're going to call it for the day. So how about this is from Natalie. Natalie says, how about employee contributions for a corporation? It must be done through payroll, which is too late for 2020. If I set up the plan now for 2020, I can only do employer contributions, profit sharing contributions, correct?
So there is a little bit of a workaround. It's incredibly complicated, but there's still a possibility to make the contribution. Remember, the Secure Act did not differentiate between employee or employer contributions. It said you can set up the plan. That's proof. It said you can set up the plan and you can still fund it by the deadline. The fact that they still give you the opportunity to set up the plan means you still have some opportunity to fund both employee and employer. There is a workaround. It's complex. It's not something you're going to be able to do on your own. You'll have to talk to an accountant that can show you the ins and outs of it, but it can be done.
Awesome. Cool. Well, guys, I know that there were still a handful of questions that you had here. That's all the time that we have for today. If you have questions that were unanswered, or if you just are feeling like you need some guidance around this topic, then I would definitely recommend click that button wherever it is to contact Nate's team. Let them know a little bit about you, and they'll let you know if they're able to help. I've known Nate for a long time. He's really honest. If there's something that he can't help me with, he'll just tell me. So if there's something where they're not able to assist you, they'll let you know. But chances are they are going to be able to really put some things in perspective. And your job opening a solo 401k plan is not to become a retirement expert, okay? That's not your job. Just because you are choosing your own investments and self-directing your retirement plan doesn't mean you all of a sudden need to become an expert in tax law. You just don't. That's why there are tax professionals who have this as their area of focus. So make sure you reach out to Nate if you have any questions. His team will be here to help. Nate, anything else to sign off before we finish up for today?
I got to say something nice about you guys. I've worked with a lot of solo 401k advisors. I call them the paperwork folks, the folks that work with the do's and don'ts. And the Neighbors Group is by far that they have it together. They're the most professional. They follow up with their folks the best. And it's so important you guys have a team around you. And you guys have been the easiest to work with from a CPA's point of view. So it goes both ways. Can't thank you enough for keeping people on the right side of this, because as an accountant, the risk of failure when it comes to this stuff, it's different than normal taxes. You goof this up, you commit what's called a prohibited transaction, you can destroy your entire retirement, just like that. So it is so critical that you work with the right people. The stakes are so much higher than normal taxes. And I just, I got to say that, Jeff and Rachel are far and away the best people to work for on something that's so high stakes.
You're awesome. Well, thank you so much for being with us today, Nate. Thank you, everybody. If you have any questions, reach out to Nate's team. We will have the replay of today's session available in the Solo 401k network. If you have not yet joined us there, come on over. It's free. It's open to everyone. It's at solo401k.net. Our experts are in there answering questions, helping you out, make sure that you have access to knowledge-based articles and trainings just like this one. The replay will be up in there later today. Have an awesome rest of your day. We'll see you on the next training.
Thank you for